Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Catherine LeGraw. She's an asset allocation strategist over at GMO, and we are talking about their newly released value ETF, US value ETF, ticker GMOV. It's really differentiated from traditional passive value. I think you'll find our conversation very interesting. They apply their own accounting principles to really find the underlying value of a lot of these names that might not be uncovered. So we talk a bit about that, but without further ado, please enjoy this episode with Catherine LeGraw. Hey, Catherine, welcome to the show.
Well, thanks for including me.
So before we get started, why don't you take a little bit of time, tell everybody a bit about your background and how you eventually ended up here at GMO.
Yes, I am an asset allocation strategist at GMO. And the asset allocation function is maybe a bit different than how you think about most investment roles. A lot of folks in the investment industry are focusing on specific securities, looking at particular stocks and bonds. I'm looking at things top down at the asset class level and looking for great opportunities from a valuation perspective on asset classes or groups of stocks. And then my team runs multi-asset portfolios where we're dynamically shifting the allocation as opportunities change. Valuation is really our guide in picking these allocation changes. I joined GMO in 2013. Prior to joining GMO, I had followed the firm for quite some time. I read the quarterly letters. I followed the forecasts on the website. And I think what drew me to GMO was, in particular, beyond that thought leadership, I love that GMO is a private partnership. We're employee-owned, so we answer only to our clients and to ourselves. And I also love this valuation philosophy, which permeates throughout the firm across all investors and strategies. It's a really unifying philosophy. Prior to joining GMO, I worked at BlackRock and BlackRock's predecessor firm, which you may or may not recall, Barclays Global Investors, BGI. Both were a wonderful, broad introduction to the investment management industry. Great places to get started. And my very first job out of school I was an investment banking analyst at Bear Stearns.
Okay, that's great. Awesome background, and thanks for sharing it with me. But before we jump into all things value and GMO and the firm, I got to ask, when you're not behind the desk, what do you like to do? Any hobbies, things you enjoy?
I do love to get away from the desk, and I like to literally go outside. I love hiking. I think it's a great way to disconnect and clear your mind. I particularly like exploring new and different trails. So that's a favorite hobby of mine.
Yeah, no hiking for me for the foreseeable future. It is freezing cold in Pittsburgh, and I'm not a cold guy, but somehow I still live here. So
I strap on the snowshoes or micro spikes and I go.
Yeah, well, you're braver than I am. So let's talk about GMO as a whole. So I know you guys have a suite of ETFs, but what all do you do to help service clients? I know it's more than just, ETFs and these types of products. So as a firm, what are you doing to help, on a massive different slew of things?
Yeah, the ETFs are actually a brand new initiative for us. And so that's part of the reason we're excited to be talking to you. We're a global investment management firm across many asset classes, founded in 1977. So we have investment teams focused on asset allocation, in addition to dedicated teams focused on equities, rates, credit, and hedge funds. So I'd say basically everything in liquid assets we do for our clients, and it's the full spectrum. We have some active, ready-to-go strategies that clients will just select and say, hey, that's a good fit for my portfolio. We also partner with a lot of our clients, be it institutions like foundations, endowments, pension funds, wealth management firms, and we will design something that's a little bit more customized to their specific needs, either their desired risk parameters, their desired objectives, or maybe even just how they want to receive the strategy from a liquidity perspective. I actually particularly love working on that. I think we in the investment industry all know that it's not one size fits all in investments. It really depends on the investor and what their end objective is. And so making a strategy actually suit that investor's needs makes it work for everyone.
So you alluded to it earlier, at GMO, value kind of reigns king, right? So we're going to talk today mostly about GMOV, which is your US value ETF. So since we know that GMO is value based, what makes GMOV kind of unique compared to other value focused ETFs out there on the market?
Yeah, I think there are three things that are really differentiated in our approach to capturing value in GMOV. First and foremost, we take a top-down approach and we look for entire groups that are dislocated or misvalued. And I think that is pretty unique to GMO, and it comes from that asset allocation capability that we have. To date, that steers us to deep value stocks, the cheapest 20% cohort. That cohort is completely dislocated. It is extremely cheap relative to its history, and we think phenomenal opportunity. Value wins, deep value always wins by more. So we're really focusing on that deep value cohort in GMOV. The second thing we do that's differentiated is as we're selecting securities, we don't rely on reported accounting data. At GMO, we've actually restated the financials for every company in our investable universe to better reflect true underlying fundamental value. As an example, we consider research and development to be an investment rather than just a current expense. So we're going to capitalize that as an investment and turn it into an asset on the balance sheet, showing that the company has additional intellectual property. And the third thing we do that's unique and different is we also look at forward-looking projections for each company. So we've created a forward-looking projection for every company in our investable universe, and that projection is calibrated and tailored to that company's unique characteristics, including their quality and their growth prospects. So we come up with an estimate for how enduring a company's profitability can be forward-looking using our models. So those three things, the top-down approach, the fact that we don't rely simply on reported accounting data, and the fact that we also create forward-looking projections for each company, I think that really differentiates GMOV.
Great. That's awesome. So you mentioned this quickly about deep value opportunities. So how does GMOV balance, deep value opportunities with other things such as quality and growth characteristics in the overall portfolio construction?
Yeah, I'd say there are a few things that we use to balance deep value with these quality and growth characteristics. I think part of what you're getting at is, hey, you don't want to buy something that's cheap for a very good reason. You want to buy something that's truly attractive fundamentals and happens to be trading at a wonderful valuation relative to those fundamentals. So by not using those simple ratio-based accounting metrics, we're not looking at simple price to book, price to sales, price to earnings. That's one thing that helps. We're actually building our own estimate of what the fundamental value is and looking for a company that's trading an attractive price relative to our estimate of its fundamental value. And that fundamental value estimate does incorporate a lot of characteristics of quality and growth, because when we're projecting forward profitability for each company, those metrics are key determinants of future profitability. A company with very good quality characteristics like strong profitability, stable profitability through time, low reliance on external financing, low leverage, those are the companies that are likely to have an enduring terminal profitability greater than their industry group or greater than the overall universe. So that's one way. Another thing we do is we do screen companies for red flags or potential problems. So what's an example? There's three categories we look at for potential red flags, and there's just dozens of metrics we look at. Any company is going to have 1, 2, or 3. But when you find a company with 10, 12, 15 red flags, then you start to worry and maybe flag that company is not someone you want to own. So the types of metrics we're looking at, accounting metrics, like a company that's built up accruals or a company that has a surprise impairment charge. We look at management metrics, aggressive management behavior, too much M&A, too much share issuance. We look at market metrics, signals the market is giving us that there might be a future fundamental impairment for the company. If there's a lot of interest in shorting this particular company, if there's a very quick drop in the price, we'd call that a synthetic profit warning. The market is telling you something is happening here. Again, it's all about this growth of many of these metrics that gives you a sign that, hey, this could be a value trap. So those are a couple of things we do to make sure we're not buying a company that's really cheap for a very good reason.
Yeah. So when kind of constructing GMOV and the holdings underneath, how do you handle kind of the common sector biases that come with value, right? So such as overweights to utilities and underweights to tech. So how are you trying to balance that inside the portfolio?
Our view is we're willing to take sector bets and sector overweights and underweights if they are supported by our view of valuations. So one example there would be financials. We have a lot of financials exposure in GMOV, and we think we can find a lot of banks and financial companies that are genuinely cheap, trading at attractive valuations relative to their underlying fundamentals. However, on the other hand, most value approaches, value indexes, and many other value strategies will be overweight something like utilities. That's something where currently in GMOB, we have no exposure to utilities. Even though it's typically an overweight in value portfolios, if we're not finding companies that meet our definition of cheap, we're just not going to hold the sector at all. So with our guidelines from a sector perspective around the benchmark, we do run a quantitative approach. We're running a risk managed approach. We do have parameters and guidelines. But one thing we've done that's pretty unique is we have asymmetric bands around the benchmark. We're willing to overweight something that we think is cheap, and we'll put a cap on that. But we're willing to underweight a security, a sector, or an industry group that we think is expensive down to 0. So we're not holding anything in the portfolio that we think is expensive just for risk control.
So I was going to ask a question on, the role of sentiment and some other things and not getting stuck in a value trap. I think you did a great job already answering that. So I'm going to skip ahead, and I want to, we have been in a long period of relative underperformance of value versus growth. I mean, even, in our funds that we run everything equal weight, and market cap is run right over us. So, what is your perspective on this extended underperformance of value over really the past decade? And do you see this as a massive opportunity? At least I do see it as a massive opportunity for those of us that are value investors or those of us that are more equal weight tilted investors.
I absolutely do see it as a massive opportunity today. In terms of my diagnosis for what's happened, how, if we had such a long sustained period of value underperformance, how has it gone on this long? I have a theory, and the theory is, in particular for this deep value cohort, these stocks have just gotten left behind, partially because it has been such a long-term period of value underperformance. In this long cycle of value underperformance, many investors, allocators have stepped away. They've allocated away from value strategies. They've allocated away from the deepest value strategies and switched to core or even growth. We can actually see this in the numbers. We can see this in flows, and we can also see this in the number of deep value managers who've gone out of business in the past 5 years, more than any other time in history. Another theory I have is that for active managers who want to stay in business, who want to survive, I think many of them have tilted away from deep value. They've moved into maybe what we would call shallow value or even more core, again, just to survive, just to keep going through this cycle. And this is combined to leave deep value behind and leave it truly extraordinarily cheap today. And I do think it's a wonderful opportunity. One bet we always do at GMO when we're trying to decide, hey, is something a bargain today, or is it really just a value trap, is we analyze what the sources of underperformance have been historically. And one thing that really made an impression on us for value and deep value is in terms of the fundamental growth, profitability, revenue growth, et cetera. Value always undergrows the market. That's a defining characteristic. That is the definition of value. But that undergrowth has been exactly in line with history. Value has been no fundamentally worse over this past decade than it was historically. It's gotten cheaper relative to the market. And so that gives us a lot of confidence that this is an extraordinary opportunity today, and you can make a lot of money by betting on value. And while I would put wide error bars around this estimate, based on a simple calculation, value needs to beat growth by about 60% to go back to historically normal relative valuation. I think that's a tremendous opportunity.
Well, even to take this a step further is you have value underperformance versus growth, but also you have massive US outperformance over international at historic levels. And I know you guys have another ETF, and we'll get back to GMOV in a second, but I know you have GMOI. How are you viewing that as an opportunity with both of these being kind of wide dislocations over the last, 3 years or more, maybe more?
So it's a similar story outside the US in the sense that deep value is extraordinarily cheap there as well. So we've got kind of top decile cheapness in deep value, both in US markets and international markets. One difference is outside the US, value's been working. And even though value's been working, this deepest value cohort is still incredibly cheap. And as you stated, overall equities outside the US are just cheaper than US equities. Plus, you've got the fact that the US dollar is pretty expensive as well. So if you are willing to invest in stocks outside the US, you could have a potential additional tailwind for currencies. So if you ask me purely on an absolute return basis, what do I think is the better opportunity today? GMOV, the US value, or GMOI, the international value? I'd steer you toward GMOI, international value, because you've got that overall market cheapness and that currency as a tailwind in addition to the value cheapness. I still think GMOV is a wonderful opportunity. I think a lot of US investors are very S&P 500 index focused. And I think the willingness to do anything different than passive S&P 500 index will benefit you today. So definitely consider a value approach.
Yeah, I mean, even with all the advisors that I talk to on a daily basis, it's like they don't even want to own international anymore in a diversified portfolio because it's dragging on benchmark return. They are, continually overweighting tech into this because they want to keep up, right? And I just think, as you've stated eloquently, more eloquent than I can, that, there are definitely opportunities. And now I think would be the time to start diversifying into value, start picking up some international tilt, and getting this portfolio a little bit more balanced out. Because I think a lot of model portfolios out there have drifted from model and have gotten pretty top heavy US growth and specifically market cap weighted growth. So staying on value, and you had mentioned passive. So in your view, why do passive approaches to value investing kind of fail to capture true economic value? Like, why GMOV over, not to put any competitors out there, but this is the first one, like a VTV, right? Just buy value passively. Why do you think an active approach to this is going to yield, better opportunity going forward?
There are a few things I think passive value is missing. One, passive value tends to rely a lot on reported book value. And I think reported book value misses a lot. It could even be meaningless. Gave some examples, but a lot of companies, they have many assets that are not on their balance sheet in a reported book value sense. Their intellectual property, their brand value, things that they have invested in, but all that investment has just been viewed by standard accounting as an expense. So that information is lost. The second thing I worry about with passive value is they use primarily backward-looking metrics. And I think sometimes you have to think about the future. What is the potential profitability going forward for this company? Why do I want to hold the company today looking forward? You mentioned sector biases. That's something I get worried about. There are sectors that tend to be favored by value approaches where we're not finding any incredibly cheap companies at all. Utilities was one example. We don't find a lot in real estate or REITs either right now. So we don't want to necessarily take all of the sector weights and overweights of a traditional value approach. And then the final thing I'd mention is they do nothing to screen for value traps. That's not their role. They're just screening on finding low multiple stocks. So those are a few things I'd be wary of with simply going with passive value today. The one thing I would add is where we see this opportunity in deep value, passive value gets a lot of what we would call shallow value. And in the US, shallow value is actually trading at the very expensive end of its historic range. So I would say that's not how to best capitalize on the deep value opportunity. In our metrics, deep value looks about third percentile versus history. It's basically never been cheaper. And shallow value is trading 79th percentile, so sort of at the upper end of its historic range. Not the best way to capture today's opportunity.
So speaking about capturing today's opportunities, given current market conditions, where does GMO kind of see the greatest value dislocations, and how are you positioning GMOV today in order to try to capitalize on those?
It's really all about that deep value cohort, really focusing on that cheapest 20%, because in a reversion scenario, that's where you can make the most money. Deep value is like high beta value. And when I look through historic periods, whenever value wins, deep value wins by more. So that's why we're really focusing on getting that very cheapest cohort. That's why we're willing to take asymmetric parameters around the benchmark so that we don't end up holding any of the more shallow value or really pretty expensive stocks in the value index just to do risk control. If you're looking for more of a sector point of view there, we are having a lot of exposure to things like financials. There is, we think, a lot of pretty high quality things from a financials perspective in the value book today, but we're finding opportunities across most sectors today. So we find a lot of opportunities to invest across things like communication services, consumer discretionary, healthcare. We're finding a lot to do in those areas, and those might not be traditionally thought of as value segments.
So from a portfolio construction perspective inside of GMOV, about how many names in this portfolio at any given time? Are you buying, a bunch of stuff, or are you very concentrated?
We're diversified. We're taking a quantitative approach, and you should expect to see, round numbers, about 150 names in the portfolio at a time. So it's not all the eggs in one basket. We're trying to capture that deep value cohort, but we're doing it with many, many different securities.
And when, weighting those 150 securities, how are you making weighting decisions inside this portfolio? Is it, are you making a bet? Is it market cap? Is it equal weight? Like how would you see this portfolio constructed?
It is a risk managed approach relative to a benchmark. So while it's not a pure market cap approach, there's that element of market cap to it because we're managing relative to a market cap benchmark. And it is a trade-off between our projected alpha, which is based on how cheap the company is, and the tracking error it creates relative to the benchmark. And we have those wonderful asymmetric parameters where our philosophy is underweight anything we think is expensive down to zero. There's no way to hold it at all. But we are going to put an upside cap on how much we'll hold of any one security, any industry, any sector. We don't want too much concentration in one idea in this portfolio. That's not what we're getting at. And hence we end up with about 150 names.
Got it. So I know the portfolio is active. So in terms of turnover, how often are you guys adding, removing, reweighting? I'm sure it's a daily process, but is there a more quarterly or weekly or annual or monthly, snapshot and look where you're doing a lot of work?
You're catching the right theme because with value, for the value investor, and I think we as value investors don't always think about this that much, but that turnover, that rebalancing, that is the largest source of relative return for a value investor. When you think about the sources of relative return for a value investor compared to the market or compared to the growth, value stocks always fundamentally undergrow. By definition, these stocks are trading at a discount for good reason. They always out-yield the market. They have higher yields than the average stock or than growth stocks. But the big source of relative return, the big source of positive return for a value investor is this rebalancing. It's the turnover. That you will buy some stocks at a discount that don't disappoint investors quite as much as they're expecting. And then they re-rate. And you, the value investor, sell them and take profits and buy something that's become cheap. And that turnover is pretty large. Let's call it 50 to 70% a year. These are ETFs, so they are daily managed. We're reacting to flows. But think about our full refresh on a model basis, typically happening about monthly. Fundamental data does not get updated that frequently. So you can think about a monthly cycle, but really it is a turnover approach because that's how you capture the benefits of value investing.
Of course. So you're sitting down with an advisor or somebody constructing, model portfolios. How would you recommend they use GMOV or even GMOI in this case as well inside an already diversified portfolio?
I think there's 3 good uses for these ETFs today. First and foremost, you could use GMOV or GMOI as a substitute for existing passive or active value exposure. The key to our approach that I think is going to be different than what you hold right now is that we are going deeper into value. And so we expect to outperform when value wins. We'll outperform passive and traditional active value. So when I look at GMOV and GMOI compared to other passive value indexes, we're trading at about a 15 to 30% discount to value. It's really a much cheaper portfolio. Second, if you don't have value exposure, value is extraordinarily cheap today. I suggest you use these ETFs to take an opportunistic bet on value. At GMO, we actually think that at fair valuations, at equilibrium, value should deliver market returns. We don't think there's an enduring value premium. We think value will outperform when it's priced to do so, and it's really priced to do so today. So if you were ever going to consider value exposure in your portfolio, now is the time. And the third way to use them is, I think there's a lot of love for the S&P 500, and I'm pretty concerned about it as an index. It's near peak valuation on almost any metric you look at. It's at peak concentration. The top 10 stocks in the index make up the greatest percent of market cap and volatility that we've ever seen. So the passive investor is not getting diversification. They're getting a lot of company-specific risk. I think you can use GMOV or GMOI just as a vehicle for diversifying away from S&P 500 exposure.
Yeah, sidecar to S&P. Well, Catherine, I really appreciate your time. This was, enlightening, and I think you guys are. I just looked. You've launched pretty recently, so I think you've got pretty good timing. So, but I can't let you go unless people learn about where they can learn more about GMO, where they can find your ETFs, and get all the information they need.
Oh, please visit us at gmo.com. You can learn about our ETFs. You can also find our quarterly letters and our asset class forecasts and other resources.
Well, again, thank you very much.
Thank you.